In this video, we're going to try and address an interesting question about what is called as working capital. It's a very common question that keeps getting asked in a lot of finance interviews about whether working capital should be positive or negative. And that's what we are going to try and address in this particular video. So let's start with a couple of questions. Should working capital be positive or negative? And what is a good current ratio for a firm? We all know that current ratio is something that is defined as current assets by current liabilities. If the answer to the first question for you is positive, and if the answer to the second question is, either greater than 1 or in certain cases greater than 2 is an optimal current ratio, then that's something that we need to discuss further to try and understand whether we have a correct interpretation or understanding of what we mean by working capital. Before we move any further, let's try and define what do we mean by working capital. So the common definition of working capital is given as current assets minus current liabilities. We keep hearing definitions such as, working capital is the amount needed for the day-to-day operations of a firm, right? Now, there's something missing in this definition. For example, if working capital is to be defined as the amount needed to run day-to-day operations of a company smoothly, imagine a company having current assets of 100 and current liabilities of 100. As per the definition or the formula, the working capital would work out to 0. But does that mean the firm needs nothing in order to run the day-to-day operations? That's not true, right? So it's something that is missing in that definition. The correct definition of working capital is the amount that is needed to be funded, the keyword being funded, in order to run the day-to-day operations of a business smoothly, right? So let's try and dig a little bit deeper. A lot of us think that current assets being higher than current liabilities kind of help a company and makes life easier for a business because you have more assets to cover your liabilities. Remember, this is true from a banker's perspective. But if you're running a business, if you're an equity owner or in general a business owner who's trying to run their own business, then the questions need to be answered slightly differently. For the purpose of this analysis, always remember that a correct definition or a better way to look at working capital is non-cash current assets minus current liabilities, right? Let's try and focus on this definition. For this video, just assume that there is no cash that exists. We just keep cash aside for a minute, and there are more nuances on how you deal with cash as a current asset, but for a minute just assume cash is not there. If you keep cash aside, then there are a few questions we need to answer. Current assets would typically be your receivables and inventory, right? Accounts receivable where you have sold something to customers but they're yet to pay, and inventory where you have purchased raw materials, they're finished goods but you've not yet sold them, right? Current liabilities, on the other hand, would be payables, right? You have taken some raw material supplies from a supplier, but you're yet to pay the supplier at this point of time. Now let's ask a few questions to ourselves if we are running this business. Question 1. Would you want your customer to pay now or later? Just think about it. Question 2. Would you want to keep a high inventory or a low inventory? And the third one, would you want to pay your supplier now or later? Right? So if you think about it from a business owner's perspective, the answer to the first question would be you want your customer to pay now, you want to keep low inventory, and you want to pay your supplier later. In other words, you want practically zero receivables. If the business does not suffer and all other things being equal, you would want zero or low inventory, and assuming it doesn't impact your business, you would want high payables. In other words, you want a lot of current liabilities and you want very little current assets. Intuitively, you want negative working capital. You don't want positive working capital when you're running a business. So what gives? What is this divergence in what we read in some textbooks and what we are looking at or deciding if we are running a business ourselves, where we would ideally want to run the business on somebody else's money? The correct answer to this is if you're a business owner, in an ideal scenario, assuming it does not impact your business, you would desire or you would want to have negative working capital. There's obviously a trade-off in this because you run the risk of current liabilities piling up and at some point of time liquidity becoming an issue for the firm. But that's a conscious decision that a lot of business owners take. In fact, some of the most successful companies in India, likes of Maruti, the likes of Airtel, would basically run negative working capital. And there are variety of aspects of a business that define how negative or positive working capital could work out. But needless to say, if you're running a business as a business owner, negative working capital is a desirable state of affairs, right? So far so good. Let's try and decode this a little bit further. Let's assume that we run a business which is a simple computer assembling business. So we have a bunch of suppliers who are giving us, supplies for, let's say, 40K per computer. And I'm going to sell an assembled computer to a customer and I'm going to sell it at 50K. Assuming my business is cash settled, right? I get 50K from the customer, I pay 40K to the supplier, I'm left with 10K. This 10K or 10,000 is basically going to take care of my other operating expenses, which could be, salaries, electricity, rent, so on and so forth. And then if something is left, that's my profit, correct? Now at this stage, assume that your customer says that he or she cannot make this payment right away. This money is not coming right now. At this point of time, your business will show a receivable, right? A receivable of 50,000. That's a current asset. Non-cash current asset is 50,000. 50,000 minus your current liabilities, which we're assuming to be zero at this point of time, is going to give me a working capital requirement. At this point, there is no payable, there is no current liability. So my requirement here would be 50,000. This is my working capital. This is the requirement of working capital in the business. This is the amount that needs to be funded. I repeat, funded in order to run your business operations smoothly from here on. If this money is not funded, something or the other will not be business as usual. You will either not be able to pay your suppliers, or you'll not have profitability, or you'll not be able to pay rent, or something or the other of that sort is going to happen. How do you fund this? The easiest way to fund this is to go to your suppliers and request them that, okay, we are going to pay after some time. So let's say this becomes 40,000. What's left? What's left is 10,000 now. Now you're left with only 10,000. That still needs to be funded in order to run business as usual, right? Now there are various ways you can fund it. I can go and take a short-term loan, in which case my current liabilities will become 50,000 and working capital requirement would be zero. I can also pull this money out from my own cash balances. Recall, we had assumed that cash is outside of our discussion. Now bring cash into the discussion. I can take money out of my pocket, put it in my business. Later on, when my customer pays me 50,000 and I pay my supplier 40,000, I can put that 10,000 back into my account, correct? In simple terms, if my working capital goes up, that's negative for the cash flow of the company. Cash flow will go down, correct? So understand that current assets, when they pile up, when they go up, they block cash for a company. Current liabilities, on the other hand, when they go up, they release cash for the company. It's a bit counterintuitive if you think about it, but if you just forget what you read in textbooks and just think about it from a business perspective, remember, when you're running a negative working capital business, you are running the business on someone else's money. Amazon takes money from us and then the entire business cycle goes on. Airtel, you go and buy a prepaid card, you pay the customer advance upfront, that's a liability for Airtel, current liability, and then they give you the entire service after that. Maruti, there's no receivable, there's very little inventory that they keep. They also settle the payable accounts pretty quickly, but all they need to do in this equation is that if receivables are close to zero, the inventory has to be maintained at very low levels, and by definition you'll be able to manage a negative working capital business. So the answer to this question is, ideally, negative working capital is a desirable state of affairs. Some businesses can have it, some businesses face it tough to get negative working capital. That's a discussion for some other day. That's broadly it in this particular video. Thank you.